Valuation, Measuring and Managing the Value of Companies, 7th edition, by Tim Kohler, Mark Goddard, and David Wessels. Picture this: two young entrepreneurs, Lily and Nate, running a trendy clothing chain called Lily's Dresses. They're hustling, growing, living the dream. But here's the thing that keeps them up at night. The same question that haunts everyone from corner shop owners to Fortune 500 executives. Are we actually winning, or are we just busy? Here's their situation. They dropped $10 million of their own cash into this venture, and last year they pulled in $1.8 million in profit. An 18% return. Not too shabby, right? But hold on. They could have just tossed that money into an index fund and earned 10% while binge-watching Netflix. So yeah, they're doing better than that. They're creating value. But then comes the curveball. Enter Logan, Lily's cousin. Logan's business is exploding. His profits are shooting through the roof, making Lily and Nate's steady 5% growth look kind of meh. Suddenly they're second-guessing everything. Is Logan some kind of business genius? Are they missing the secret sauce? This everyday drama contains one of the most powerful ideas in business, a principle that's guided the world's most successful companies for over a century. It's all laid out in what many consider the ultimate guide to corporate value. Valuation, Measuring and Managing the Value of Companies. Now, in its 7th edition, this isn't just another business book gathering dust on a shelf. It actually started as the private playbook for McKinsey & Company, one of the world's most elite consulting firms. Written by three absolute heavyweights, Tim Kohler, Mark Goddard, and David Wessels. It sold nearly 1 million copies and become the go-to resource for chief executives, investors, and anyone serious about understanding what actually makes a business valuable. Today we're diving deep into this masterpiece, and here's my promise. By the time we're done, you won't just get what happened with Lily and Nate. You'll understand the fundamental, unshakable laws of value creation. You'll see business not as this chaotic whirlwind of stock tickers and dramatic headlines, but as a system governed by simple, elegant truths. Whether you want to build your own empire, invest like a pro, or just understand how money and business really work, this is your foundation. So what was Lily and Nate missing when they looked at Logan's seemingly unstoppable business? Their mentor dropped this wisdom bomb. You're looking at his profits, but you're asking the wrong question. You're not asking what it cost him to generate those profits. And boom, that's the first major insight. Value isn't just about how much you earn. It's about how much you earn relative to the money you had to put in to get it. This concept is called return on invested capital, or return on invested capital for short. Think of it as a performance review for every single dollar you put into your business. If you invest $1, does it generate 18 cents annually, like Lily and Nate's business, or something less impressive? When they dug deeper into Logan's operation, the truth came out. To fuel his rocket ship growth, he was dumping massive amounts of cash into new stores, flashy marketing campaigns, and expensive inventory. His return on invested capital, his actual return per dollar invested, was actually dropping. And because he had to reinvest so much profit just to maintain his growth trajectory, he barely had any real cash left at the end of the year. Lily and Nate, though? They had something special. Their designs stood out. Their operations were lean and efficient. They had a genuine competitive advantage. Because of this edge, they didn't need to burn through cash to attract customers and grow. Their return on invested capital was strong, and so was their cash flow. The lesson they learned that day is the beating heart of this entire book. Growth only creates value when it comes with solid returns on capital. A company only creates value when its return on invested capital exceeds its cost of capital. What's the cost of capital? Simple. It's the return investors could get somewhere else for taking on similar risk. For Lily and Nate, it was that 10% they could have earned in the stock market without lifting a finger. Because their 18% return on invested capital beat their 10% cost of capital, their business was a genuine value creation machine. Logan's business? It was heading toward dangerous territory. If his return on invested capital dropped below his cost of capital, every new dollar he invested to grow would actually destroy value, not create it. This is profound stuff. Growth, the holy grail every company chases, can actually be toxic if you're not earning decent returns. It's like pouring more and more money into a savings account that pays less interest than inflation. Sure, you're getting bigger, but you're actually getting poorer. Lily and Nate embraced this truth. They realized the game wasn't just about growth, and it wasn't just about return on invested capital. It was about finding that sweet spot between the two. A few years later, inspiration struck. They wanted to launch Lily's Emporium, larger stores with a wider range of clothes and accessories. But their finance team brought some uncomfortable news. The new concept needed massive upfront investment. For the first 4 years, even though profits would grow faster, their return on invested capital and cash flow would actually decline. After that, cash flow would surge. They were stuck. How do you weigh short-term pain against long-term gain? How do you compare a dollar today to a dollar 5, 10, or 20 years down the road? This brings us to the second game-changing tool, discounted cash flow, or discounted cash flow. It sounds intimidating, but the core idea is elegantly simple. It's a way of looking into the future, seeing all the cash a business will ever generate, and then translating all that future cash into today's dollars to get a single, clear number. Why translate it back? Because a dollar you receive 10 years from now is worth less than a dollar in your hand right now. You could invest today's dollar and earn returns on it. So to bring future cash to the present, you have to discount it by a rate reflecting that opportunity cost, your cost of capital. When Lily and Nate ran the discounted cash flow model, everything crystallized. Their current business was worth about $53 million. But the new Emporium concept, even with the short-term cash flow dip, was worth $62 million. The long-term payoff was so powerful, it crushed the short-term pain. The discounted cash flow model gave them the confidence to make that bold leap. It's a tool that lets you see beyond the immediate horizon and make decisions based on a business's entire lifetime value. Armed with this new understanding, Lily and Nate kept pushing their thinking. Lily raised a clever question. If higher return on invested capital is better, shouldn't we just shut down our stores that are only earning 14%? That would boost our company's average return on invested capital, right? This is a classic trap, and it introduces the third key concept, economic profit. The real goal isn't maximizing your percentage return. It's maximizing the total dollar value you create. Think about it. Their cost of capital was 10%. Those stores earning 14% were still generating 4 percentage points above the threshold. They were still creating value. Closing them would make the company's average return on invested capital look prettier on paper, but it would make the company smaller and less valuable in absolute terms. Economic profit captures this beautifully. It's the spread between your return on invested capital and your cost of capital, multiplied by your total invested capital. It tells you, in cold hard dollars, how much value you created in a given year. When Lily and Nate crunched the numbers, they saw that closing their lower performing but still profitable stores would actually shrink their total economic profit. The takeaway? Don't chase pretty percentages. Chase real value. Lily and Nate's journey was about to hit its biggest milestone yet. Their Emporium concept crushed it. The business was scaling so fast, they needed more capital than they could generate internally. It was time to go public. And this is where things get really fascinating. Because when a company enters the stock market, it enters a completely different arena with different rules. The authors call this the expectations treadmill, and it's one of the most critical concepts for any aspiring leader to grasp. Until now, Lily and Nate had been competing in the real market, the world of customers, products, and cash flows. In the real market, you create value by investing capital at returns higher than your cost of capital. Straightforward. But in the financial markets, the stock market, the game changes. A stock's price isn't based on what a company has accomplished. It's based on what investors expect it to accomplish in the future. When Lily and Nate took their company public, Its intrinsic value, the present value of all future cash flows, was about $20 per share. But the actual money they'd invested over the years, their book value, was only $7 per share. That extra $13 represented the premium investors were willing to pay for all the future economic profit they expected the company to generate. Lilly nailed the crucial question. If investors pay this premium up front, how do they actually make money? Here's the answer. If the company performs exactly as expected, investors will only earn a return equal to their opportunity cost, that same cost of capital, that 10%. The only way for shareholders to earn higher returns is if the company beats expectations. Perform worse than expected, their returns drop. This is the expectations treadmill. Imagine you're a chief executive. You've just turned around a struggling company. Performance is improving, and because nobody saw it coming, your stock price rockets. You're the hero of the hour. But now the treadmill has accelerated. Investors don't just expect you to be good anymore. They expect greatness, consistently. Now you have to run even faster, deliver even better results, just to keep the stock price where it is. If you merely continue being great, exactly as everyone now expects, your stock performs just average. To get another surge in share price, you have to become superhuman. This explains why a wonderful company isn't always a wonderful stock. A highly profitable, well-run company might be a terrible investment if its stock price already reflects the expectation of perfection for the next decade. Conversely, a struggling, mediocre company might be a fantastic investment if its stock price reflects expectations of failure, because beating those low expectations is much easier. This pressure to constantly exceed ever-rising expectations can push managers toward foolish decisions. They might obsess over short-term profits instead of long-term value. They might slash research and development or cut corners on safety just to make this quarter's earnings look presentable. Or they might chase a huge, risky acquisition, hoping for a blockbuster win that satisfies the market's insatiable hunger for growth. These actions are the complete opposite of genuine value creation. They prioritize today's shareholders, who want a quick pop in stock price, over the collective value for all shareholders, present and future. This connects to another powerful principle in the book, the conservation of value. It's simple but profound. You can't create value just by shuffling the deck chairs. Anything that doesn't actually boost a company's cash flows doesn't create value. Consider share repurchases or buybacks. This is when a company uses cash to buy its own shares from the market. When this happens, the total number of shares decreases, so earnings per share often increases. Looks like magic, right? Higher earnings per share without even working for it. Many executives fall for this illusion, but the conservation of value principle tells us to ask, did the total cash flow of the business increase? Nope. The company simply used its cash to buy a piece of itself. The total pie is the same size. It's just sliced into fewer, bigger pieces. While earnings per share went up, the company now has less cash or more debt, making it riskier. Investors recognize this increased risk and demand higher returns, which pushes down the company's price-to-earnings ratio, the multiple they're willing to pay for those earnings. The higher earnings per share is often perfectly offset by the lower price-to-earnings ratio, and no real value is created. The same logic applies to fancy accounting maneuvers or complex financial engineering. Unless an action increases the cash generated by business operations, either by boosting revenues, improving margins, or using capital more efficiently, it's just moving value around. It's not creating it. Markets are smarter than most people think, and in the long run, they won't be fooled by smoke and mirrors. This brings us to the final piece of the puzzle, risk. We've talked extensively about cost of capital, that hurdle rate a company must clear. But where does that number come from? It's all about risk, but a very specific type of risk. Imagine you own a single company. You're exposed to all kinds of risks. A key employee might quit. A new competitor might open across the street. A factory might catch fire. These are all diversifiable risks. Why? Because smart investors don't just own one company. They own portfolios of dozens, even hundreds of stocks. If one company's factory burns down, another company in their portfolio is probably having its best year ever. These company-specific risks tend to cancel out across a diversified portfolio. Because investors can eliminate this type of risk for free just by diversifying, they don't demand compensation for it. It doesn't affect the cost of capital. So what risk does matter? The risk you can't eliminate. This is called non-diversifiable or systematic risk. This is risk that affects almost every company in the economy, like recession risk, interest rate changes, or global crises. Because investors can't diversify away this risk, they demand to be paid for bearing it. This is the risk that's priced into the cost of capital. This is a game-changing insight. It means most of the daily risks managers worry about, a product launch flopping, a competitor's aggressive ad campaign, don't actually change the company's cost of capital. Those risks absolutely affect the company's cash flows, but they shouldn't be handled by randomly jacking up the discount rate. The authors make this crystal clear. Instead of adding a vague risk premium to your weighted average cost of capital for a project in an emerging market, for example, it's far better to think through different scenarios. What happens to cash flows in a business-as-usual scenario? What happens in a political crisis scenario? By modeling these different outcomes and assigning probabilities, you get a much clearer, more honest picture of the project's true value and its risks. This forces real conversations about actual business issues, not just abstract arguments over discount rates. So let's bring everything back to Lily and Nate. Their little dress shop became a massive enterprise. They mastered the fundamental laws of value. They learned that a business creates value only when it earns returns on capital higher than its cost of capital. They learned that growth is a powerful value amplifier, but only when that first rule is satisfied. They learn to use tools like discounted cash flow to peer into the future and make bold, long-term decisions. And when they entered public markets, they learned about the relentless pressure of the expectations treadmill. Their story is the story of every business. It's a journey from passion and gut instinct to a deep understanding of the simple, timeless principles that separate companies that merely survive from those that truly thrive and create lasting value. So what's the real takeaway from this deep dive into valuation? It's easy to get buried in formulas and financial jargon, but I think the most powerful message is its remarkable simplicity. Despite all the complexity we see in financial markets, the core of what makes a business successful can be explained in one sentence. A company creates value when it invests money and earns returns higher than what investors could have earned elsewhere for the same level of risk. That's it. That's the engine of capitalism. Everything else, strategy, marketing, operations, is just a means to that end. And growth? Growth is the fuel that makes that engine bigger and more powerful, but only if the engine itself runs efficiently. This idea is incredibly empowering. It means you don't need to be a Wall Street insider to understand what makes a good business tick. You just need to ask two straightforward questions about any company you encounter, whether it's the coffee shop you visit every morning or the tech giant whose device is in your pocket. First, for every dollar this business invests in its stores, technology, or people, is it getting solid returns? In other words, is its return on invested capital high? Do you see evidence of competitive advantage, something that lets it charge a premium or operate more efficiently than rivals? Second, how is it growing? Is it opening new locations, launching new products, or acquiring other companies? And does that growth seem to generate good returns? Or does it feel like they're just getting bigger for the sake of getting bigger? Like Lily's cousin Logan. Start asking these two questions, and you'll develop what the authors call a value mindset. You'll start seeing the world not just as a consumer, but as an owner. And that mindset is one of the most valuable assets you can ever build, regardless of your career path. Another crucial lesson is about separating short-term noise from long-term value. The world constantly screams about quarterly earnings, stock price swings, and whether a company beat expectations. The expectations treadmill is real, and it tempts even brilliant leaders into short-sighted decisions. But this book gives you a framework for seeing through that noise. It teaches you the real game isn't about hitting quarterly targets. It's about building a healthy, resilient company that creates value for decades. It's about having the courage to make investments today in products, people, and brand that may not pay off for years, even if it means disappointing Wall Street this quarter. That's not just a business lesson, it's a life lesson. The things that create the most value, a great education, strong relationships, mastery of a skill, rarely offer immediate payoffs. They require upfront investment, patience, and long-term focus. So how can you start applying these ideas today? First, practice that value mindset. Next time you walk into a store, ask yourself, why is this business successful? What's its competitive advantage? How efficient does it seem? Is it crowded? Are employees helpful? These are clues to its return on invested capital. Second, become a student of expectations. When you see a company's stock price jump or crash after an earnings report, read beyond the headline. Was it the actual earnings number? Or something in the report that changed investors' expectations about the future? This will teach you to separate signal from noise. And finally, remember the conservation of value principle. Be skeptical of anything promising value from nothing. Whether it's a financial product that seems too good to be true, or a business strategy relying on clever tricks rather than real operational improvement, remember that true value comes from creating more cash flow. It's about making the pie bigger, not just reslicing it. That was a summary of Valuation, Measuring and Managing the Value of Companies by Tim Kohler, Mark Goddhart, and David Wessels. We've covered the core principles today, but here's the honest truth. A summary is just a map. The real treasure is found when you explore the territory yourself. The true magic happens when you read the book, and a particular story or phrase connects with you in unexpected ways. This summary is your guide to decide if this book deserves your time and attention. If anything we've discussed has sparked your curiosity, I encourage you to grab a copy. Reading it isn't just about learning formulas. It's an experience that can genuinely transform how you see business and value creation. A link to the book is in the description below. Also, if you found this journey valuable, please show your support by hitting that like button and subscribing to the channel. That way, you won't miss our next exploration into another game-changing book from the billionaire's bookshelf. Let's keep learning and growing together.